Hey everybody, it's Jason Manili with Team Manili here once again, and we are here for our monthly marketing update. This time we're coming out from a little bit different perspective. I'm here with one of our favorite lenders, and we are going to talk interest rates and what to expect when you are getting a loan. All right, everyone, this is Jason again. We are doing our monthly market update, and I am here with Damon Cademartori with Fairway Lending, and we are going to talk to him a little bit about lending today, what drives the interest rate, what he likes to see when you are coming in to get a loan, and what kind of things that you have or may not have that will affect those interest rates. So, David.
Yes, sir.
We are obviously seeing a lot of fluctuation in our interest rates, and we see a lot on the news about that kind of stuff. What drives interest rates? Because we always hear that, oh, they're down a tick, they're down, they're up, but it doesn't always seem to go with that. It seems to be other things that are driving it.
Sure.
Bond markets, those type of things.
Yeah.
So when somebody comes in and says, hey, I heard the interest rates were down, I want to refinance my house.
Absolutely.
And then you show it to them, and they're like, whoa.
Right.
That's not what I heard. So what's going on there?
Yeah, great question, right? And I would say that's the biggest disconnect that I hear. And I think a lot of that's driven by social media, right? I mean, so we're in an age where social media is really the main place where people get their information, and then that includes financials. You know, it used to be 10, 15 years ago, you'd watch the news, right, on TV. Today, you pick up your phone and you get some information pretty quickly. The problem is not all information that's sent out is equal. So what I mean by that is, you could have stuff that is sent out a week or two, it's 2 weeks old, and it paints a completely different picture than today. That's how volatile the market is. So to answer your question, I think that's the biggest reason why people may hear rates have dropped, and then we get a call and they're really up, or vice versa. Usually it's that way. It's rare that they think they're higher and they're lower. But the reason why you're seeing that big disconnect, I think a lot, is news reports will talk about the Federal Reserve, and you'll start to hear different reports that come out. There's something called an economic calendar. Just think of a calendar, right? And every day there's like a new report that comes out. Well, a good lender will understand this, and they'll look. And the reason why that's important is because when you have a loan, you want to know if you're going to float it, which means you kind of let the rate ride, and you look for a dip or a lock right away and avoid an area where maybe it could spike. Now, while nobody really knows 100%, just like anything in life, if you do a little research and you have an idea and you've been doing this long enough, you know what signs to look for. And so a lot of those things are really what's affecting the mortgage industry. So the bond markets probably is the biggest thing. It's not the Fed. Federal Reserve does not control interest rates.
Right.
They control like your HELOC rates, your CD rates, your saving rates. They can reflect on your auto loans.
They're more short-term loans, right?
Yeah, they're the overnight rate from bank to bank. Right? Somehow over the years that has transitioned to mortgages, right? Even though that's not the case. The mortgage industry loosely follows the 10-year treasury. Right? And so the 10-year, today it's just under 4.3%. You might say, well, why isn't the rate 4.3%? Well, because there's a yield spread, a portion that the investor wants to make. And this is where the bonds come into play.
Right.
So Wall Street, right, they have to buy the loans. So all the loans are packaged up into a group, and then they're sold, right? So the problem is when there's a lot of debt out there, like the United States has a massive amount of debt, there's not an appetite for somebody to buy the bonds, especially if they know when the rates drop, they're going to get refinanced. So they want something called a yield spread premium. Now, normally, in a normal market, that's about 1.5% to 1.75% above the 10-year. So really, we should be somewhere in the mid-fives, normally. Maybe a high 5.75. But for the last 2-3 years now, they've been commanding almost 3% above the 10-year.
Wow.
And that's just to get the thing sold. And when you don't sell them and you have bond auctions that go bad and things like that, it affects interest rates. And it's because there's just not the appetite for it. In the past, the Treasury, being the Fed, was the biggest buyer of mortgage-backed securities, MBSs. And quantitative tightening is what they've been doing over the last 1.5 to 2 years. It's the first time in the history of the United States the Fed has raised interest rates and did quantitative tightening at the same time. Quantitative tightening is when they do not buy mortgage-backed securities.
Right. That was to get rid of inflation, right?
Yeah, 100% right. That was to bring inflation down. Because when you lower rates, that's inflationary, right? So if, let's say, the Fed lowered the rates a point today, inflation would really spike, right? Because it's putting more money into the financial system. And so with that being said, that's why you're seeing the fluctuations. You got a lot of different things going on out there. Some of the tariffs things, it's not to blame everything, but that has kind of added some uncertainty because it hasn't happened in a long time at this level. You're talking about back to the 70s. And so, rightfully so, the markets are a little skittish. So I think that's where you're seeing the disconnect a little bit. And frankly, it's because the things are changing throughout the day. Mortgage rates adjust daily, just like the stock market. And for the average person, it's almost impossible to keep up on that.
Yeah, I think that's some of it too, is like clickbait. Right?
Oh,
they give you these huge headlines that nobody reads the headlines, or just reads the headlines, doesn't read the story, and doesn't get to the deeper story.
Yeah, you see something that says like unemployment spiked, and then you read, and it's like went up 0.1. Okay, well, that's not really a spike, right? So yeah, people tend to not read and do their due diligence,
right?
And so
okay. So if I bring in a buyer to you, and they sit here in front of you, and you start talking about this is what we need, what are maybe the top 3 things you want from your buyer to get the process started and get it going quickly?
Yeah.
They're motivated, they're ready to go. What are you going to look for?
Yeah, so every client's different, and what I mean by that is it really depends on their employment is usually the biggest thing that can speed up or slow down a pre-qualification. For self-employed, we do those very quickly, but the buyer on their end has to provide some other documents, right? We can get away with 1-year tax returns, but you got to have those tax returns, right? And if they've been in business less than 5 years, you got to have 2 years. But the biggest thing is just ready to go, take an app. I can meet them in my office. I do it over the phone. I personally take the applications. If they really want to, I can send them a link, make it very easy and accessible to do that. And then I get them a list of things that I need very quickly, W-2s, pay stubs. We can even auto-verify a lot of that stuff. If they link their companies to that, it can automatically pull like an electronic verification of employment, which is fantastic. And you can do that with your bank accounts as well. And it's all totally secure. So the biggest thing is just knowing your financials, right? An idea of your financials. Having that stuff ready, like maybe some bank statements, W-2s, pay stubs. That's really it. And then from there, I can put it all together. I can crank pre-quals out really fast. I usually do them same day. I know some lenders out there take quite a bit. This way, there's not a lost opportunity. The biggest thing I see is when realtors tell clients, listen, I really want to get pre-approved, and the client says, well, you know what, I want to go look at houses first. When things are busy, realtors say, I need the pre-approval before I go out there and show you something, because it's just they were getting stretched too much. Now you got to kind of do your gut feeling on what you think. If it's a past client, of course, but maybe it's a new client, wasn't a referral from anybody. That's where the realtors have to decide if they want to do that. But being pre-qualified really helps, because the worst thing you can do is, if the realtor has no idea where you qualify, and they just have an idea of the amount you want, and they show you an $800,000 house, you fall in love, and you find out you only qualify for $7,000. Well, now everything that person shows you after that's not going to live up to the $800,000 house, and it's just going to be a big disappointment.
Well, and technically, we're not even allowed to show you a house until we get pre-qualifications. We have to do our due diligence on our end to make sure you are qualified to look at that house. I shouldn't be bringing you into a house unless I see a proof of funds that you have X number of dollars to afford that house, or you talk to Damon and he's done his due diligence and says, yes, they can afford that house. So those are those aspects that I like him, because he gets them to me quickly. And then we get you to see the house. So those are the things that we have to work off each other for.
Great communication between the realtor and lender is really key.
Yeah.
Because especially in a market like this, we've done a lot of deals together where we just kind of think through the offers too, like, hey, what is going to help the client the best? And your lender has to be able to work through those numbers quickly with concessions and 1.0 and 2.0 buy downs, different ways to make it where it makes sense for the client and helps them get the best deal possible. And if the lender is not available because it's a Saturday and they're closed and they don't work, they're not available 24/7. Well, that's a problem, right? I mean, that's
Yeah.
a big problem.
Or you're dealing with, like one of those online mortgage companies,
Yes.
Rocket Mortgage, or one of those kind of things. Those are always hard to get a hold of people too. So whenever we get buyers, we always like to push them to Damon or a local lender that they trust, so they can have that communication between agents and client. So those Rocket Mortgages, they're fine, but you definitely want to go with somebody local that knows what's going on and can communicate well.
A local lender is a big deal. Big deal. Especially in a smaller town. I mean, our town's growing, but agents, I mean, they know who knows what they're doing and who doesn't. I mean, if they see a pre-qual coming over from Navy Federal Credit Union, I mean, all they're thinking is okay, great, it's a credit union, but what if I have a problem on Saturday or Sunday? What if I have a problem at 8 o'clock at night? Do they really understand complicated business taxes? It's more than just rate.
Yeah, for sure.
And so, whereas a local lender, the lender knows that you're in a small town, your reputation's everything. You're there, you're always there to talk to the clients. I always call the listing agents as well, introduce myself, let them know that loan is highly qualified. We don't release any personal data, but we let them know our process. And that helps as well get people under contract. So
for sure.
It's a huge difference.
Yep. All right. Anything else you would want to mention about like your process, what you would like to see?
Yeah, no, I mean, for us, the big thing is communication. You can always Google my name. I mean, I think I have over 300 5-star reviews. Those are all client-based reviews. And it's really just from taking care of clients first. I really just base it on doing the right thing, helping the realtors and the clients work together, communication. They know exactly where they're at every step of the way. So processing to underwriting to the appraisals coming in at this date. Here's a copy of the appraisal as the client. They always know their payments. There's no surprises. I'm always available for them. I take calls at 7, 8 o'clock at night. In fact, Jason tells me, please don't call this person. You need to relax, right? I've heard that for 6 years now. So, but it's easier for me just to take care of it and be done. I don't like making people wait for things, especially if you're a client. If you're like me, you worry about things. You're thinking about that before you go to sleep. If it's something that could take me 10 minutes and answer your question, I just feel better about it. It's just a different level of service that we provide.
All right, well, cool. Thanks very much for the information. I appreciate it.
Very well.
If anybody has any questions, wants to get in touch with Damon, his information is here, or you can touch base with me, and I'll get you that information as well. So hopefully you found this informative. If you like it, please subscribe. And you can find our information as usual. We're all over the internet, social media, YouTube, all that other fun stuff. So hope all is well. We'll talk to you soon and have a great day.
Yeah, thank you.